Ondas Holdings, ticker ONDS, is currently trading at $6.02, which is up about 1.22% on the session. Now, seeing a small cap tech name like this moving up slightly on an average day might not immediately grab your attention. Most people who look at ONDS see a high-concept drone company, maybe lumping it in with other speculative tech stocks they track on their Robinhood app. But the real story today isn't just about autonomous drones flying over cities. The movement we're seeing and the entire valuation of this company is linked to something far less glamorous but infinitely more critical: the deep modernization of North American railroads. The market expectation is that ONDS is a fast-moving, high-growth tech stock. The reality is that it's a heavy-duty industrial infrastructure play, and the timelines, risks, and sales cycles involved are vastly different from what most tech investors are accustomed to. When investors first find Ondas, they generally get excited about its subsidiary, Aerobotics. They see the drone-in-a-box technology, and their imaginations run wild. They picture automated security for ports, industrial site monitoring, perhaps even future logistics. It feels fast. It feels futuristic. It's the kind of story that gets traction with traders looking for the next big thing, maybe hoping it's an early-stage NVIDIA stock, catching a massive technological wave before it builds. This is the narrative that drives a lot of the retail interest and explains why fractional shares on platforms like SoFi Invest have made it accessible. But here is the fundamental disconnect, the gap between that expectation and the challenging reality. While Aerobotics is an important part of the long-term vision, the heavy lifting for the company's current valuation and immediate future prospects rests squarely on Ondas Networks. This division deals with proprietary private wireless networks operating in the 900 MHz spectrum. We're talking about connecting mission-critical industrial assets, things like locomotives, trackside signals, and utility grids. This isn't a fast-moving software-as-a-service sale. This is a slow, methodical, relationship-heavy business aimed at industries that are, to put it mildly, notoriously slow to adopt new technology. The expectation is a tech growth curve, steep and sudden. The reality is an industrial adoption curve, which is slow, lumpy, and built on pilot programs and years of validation. Confusing these two is the primary mistake investors make with this name. This 1.22% move today to $6.02 is actually fairly calm water for ONDS. If you've been tracking this name in your individual brokerage account or through Interactive Brokers, you know this stock can swing 10%, 15%, or even 20% in a single session on seemingly minor news or sometimes no news at all. This isn't Apple stock, where hundreds of billions in market cap and massive daily volume keep the price action relatively stable. ONDS is a small cap stock with a relatively low float. This means the pool of available shares for trading is small, so any significant buy or sell order, whether from a small institution taking a new position or a surge of retail interest, can move the price dramatically. This is the definition of volatility, and it's a key feature of this kind of online investment. Today's trading volume is relatively average. What we as serious analysts look for are the volume spikes. If you pull up a chart on your Fidelity trading platform, look back at the last earnings announcement or a major contract press release, you will see massive volume bars indicating significant institutional repositioning. When ONDS reports its quarterly numbers, the key figure everyone scrutinizes isn't just the earnings per share, which is expected to be negative as the company is in a heavy investment phase. The critical metrics are the backlog and the pipeline. Did they successfully convert a pilot program with a Class 1 railroad into a full multi-year deployment order? That is what matters. A simple press release about a new partnership might cause a temporary spike for day traders, but serious investors using platforms from Fidelity or those with a Schwab Intelligent Portfolios account are digging into the 10K and 10Q filings to see if that partnership has actual material dollar figures attached to it. Their last quarterly report was a perfect example of this expectation versus reality tension. Revenue was up significantly year over year, which strongly supports the growth narrative. That's great. But operating losses also widened. This is the classic cash burn phase of a development stage company. The market is constantly trying to decide, is this good spending, investing in R&D, expanding the sales force to land those billion-dollar railroad contracts? Or is it bad spending, high corporate overhead, inefficient operations? The immediate stock reaction was, as usual, volatile, as algorithms and active traders on platforms like the SoFi trading platform tried to price in that dichotomy. The company is funding this growth through a mix of equity and debt, and any potential investor must watch the cash position and burn rate like a hawk. Institutional activity is critical for a stock like ONDS. Retail traders on Robinhood stock trading can certainly move the price day to day, but the long-term floor and credibility are set by institutional owners. We're not talking about massive pension funds. We're talking about smaller, specialized tech or industrial hedge funds. They aren't building a core position in ONDS the same way they would buy broad market Fidelity ETFs or Fidelity mutual funds. They are making a very specific, high-risk, high-reward bet on the company's technology and its ability to penetrate the market. Their involvement provides some stability, but it's also a risk. If one of these small funds decides to exit their position, it can flood the market and crater the price. This is not a stock you set and forget in a basic investment portfolio. It demands active monitoring, something that platforms like Interactive Brokers trading tools are designed for. We also have to consider macroeconomic pressures. How does the Federal Reserve's interest rate policy affect ONDS? It hits them in two distinct ways. First, in a high interest rate environment, future growth stories become inherently less attractive. Why take a massive risk on ONDS, which might be profitable in 5 years, when you can get a decent, safe return from bonds or other more established equities? This pressure compresses the valuation multiple that investors are willing to pay. Second, and perhaps more directly, ONDS's target customers, railroads, utilities, oil and gas, are all highly sensitive to the economic cycle. If a recession looks likely, their first move is to pull back on large non-essential capital expenditures. That means delaying that multi-million-dollar network upgrade, which in turn pushes Ondas's revenue projections further and further into the future. This is a crucial risk that many people new to self-investing or online investing completely overlook. They see the exciting technology, but forget to analyze the customer's budget constraints. So let's briefly clarify what Ondas Holdings actually does. It's best to think of it in two parts. First is Ondas Networks. This is the core. They provide a secure, private wireless data network based on their FullMax technology, which operates in the licensed 900 MHz spectrum. Their primary, massive target market is the railroad industry for something called positive train control and other advanced Internet of Things applications. Think of it as a super reliable, high-capacity, proprietary cellular network built specifically to run alongside miles and miles of train tracks, allowing locomotives, sensors, and command centers to communicate critical data securely and instantly. They also target utilities for grid modernization and oil and gas for remote site monitoring. The second part is Aerobotics, which the company acquired. These are fully autonomous drones that live inside a self-contained robotic box on site. They can be programmed to fly missions like security patrols around a port, inspecting solar panels, or mapping a construction site, and then automatically return to the box to land, charge, and upload their data, all without a human pilot anywhere nearby. This is a very compelling product for large industrial facilities. The overarching strategy is for ONDS to be the go-to provider for autonomous, mission-critical industrial data. The networks, Ondas, provide the connectivity backbone, and the drones, aerobotics, provide the autonomous data collection. It's a synergistic model, but it's incredibly capital-intensive and requires convincing very large, very conservative industries to make a huge operational change. This is a story of patience versus potential. It really hinges on whether you believe these massive industries are truly ready to spend the capital required for this upgrade. That leads me to a question for all of you watching. Comment below what you think the single biggest hurdle is for ONDS. Is it regulatory approval for the drones, or is it the incredibly slow sales cycle for the railroads? I'm curious to read your take on this. Looking forward, the tension between expectation and reality becomes even more pronounced. The bull case, the optimistic expectation, is that ONDS is standing at a major inflection point. The argument is that the major Class 1 railroads, after years of testing and pilot programs, are finally ready to begin wide-scale